and financial conditions lead all of that. What we found is that gold has shifted its correlation from being about real interest rates to now being about financial conditions. So think of gold leading Bitcoin by 6 months. That's the work that we've done, that we think it now actually leads, because Bitcoin is liquidity. That's the key driver. Gold is being driven by this future thing, which is financial conditions. So they're all part of the same thing, but just different phasing.
Raoul Pal, who has a reputation for correctly predicting cryptocurrency cycles and global liquidity patterns, is freely admitting that the market has not performed as he had anticipated this time. The economy hasn't entered the explosive phase he predicted, despite tremendous money creation and unprecedented liquidity injections. Interest rates are still high, growth is still slow, and the ISM, one of the key business cycle indicators, is still below 50. Powell claims that this is the reason why the price of Bitcoin and the entire cryptocurrency industry hasn't increased as much as it has in previous cycles. He thinks the current cycle is abnormally protracted, delaying the actual Bitcoin peak until 2026 instead of the usual year after the halving. Powell contends that this pause is actually preparing for a far bigger and more potent rise rather than marking the end of the cycle. This cycle's liquidity buildup is slower, but far larger in scope than previous cycles when it led to sharp price jumps. He characterizes the upcoming liquidity wave as a huge offshore tsunami that is still gaining momentum rather than a ripple. When it occurs, he anticipates that it will push stocks, gold, Ethereum, and Bitcoin to all-time highs. It's possible that what appears to be stagnation is actually the quiet before the bull market's peak. According to Powell, this change signifies a change in the way contemporary cycles operate and might be the biggest macro transaction of our lifetimes. As global liquidity gradually improves, he remains optimistic that Bitcoin is headed for a 2026 peak. He makes it very clear that this hold is not a sign of weakness. Rather, consider it the prelude to the next significant phase of the cryptocurrency boom.
So the debasement trade. We talked about we're creating excess money to service the debt. That comes with a cost. What is that cost? It's like people don't really see it. They don't feel it. You don't know what it is. What it is you are lowering the purchasing power of fiat versus scarce assets. So $1 today buys you, well, $1 million today buys you less of the S&P 500 every year because the debasement of the fiat currency. Real estate, gold, crypto, art, classic cars, anything that is scarce value holds value. This is exactly the same that happened for the Venezuelan stock market. In Bolivar terms, it was up 1,000,000% or whatever stupid number it was. When you look at it in dollar terms, it was down 99%. Why? Because they debased the currency to zero. And so that's currency debasement. It's happening about 8% a year on a globalized level because all the major central banks and governments are doing this. So the debasement trade is, if this is the most powerful macro factor of all time, what are the things that offset it? Now, Wall Street is very slow on the uptake, so their first thing is gold. But measurably over time, gold has not meaningfully outperformed debasement because its job is to actually just be stable money and have a stable store of value. So therefore, you're not getting richer owning gold, you're protecting yourself from the debasement. Fine. But if you're going to lock up money in long term by buying an asset, you need to get rewarded for locking your money up. So to be rewarded, you need an asset that outperforms that debasement. So Wall Street's finally caught on to this. It's something I've been writing about extensively, probably have done more research on this than anybody else in the world. And now finally Wall Street's starting to understand the game, which is that scarce assets outperform. Okay. Now, they've all gone to gold, but gold, as I said, is a store of value, but is not a compounder of wealth. But why has gold been outperforming recently? Because there is what we call the global macro investor GMI dominoes, where things affect. There's a chain in terms of time of what works. At the front end of it all is financial conditions. How we measure financial conditions is interest rates, the dollar, and commodity prices. You kind of put a regression analysis around those. You create an index. That leads the ISM by about, which is the business cycle, by about 9 months. So that's the most forward-looking thing that we have. Then we've got global liquidity that lags by about 3 months or 6 months. I can't remember the exact number. And then we've got the business cycle. Assets fall somewhere within those, and then there's some assets that are lagged. But the business cycle is the main driver of assets in cyclical basis. On a secular basis, it's debasement. And financial conditions lead all of that. What we found is that gold has shifted its correlation from being about real interest rates to now being about financial conditions. So think of gold leading Bitcoin by 6 months. That's the work that we've done, that we think it now actually leads, because Bitcoin is liquidity. That's the key driver. Gold is being driven by this future thing, which is financial conditions. So they're all part of the same thing, but just different phasing.
When Bitcoin was around $200 in 2013, Raoul Pal wrote his first article about it, predicting that it will either crash to zero or serve as the foundation for a new international financial system. After 10 years, the first thesis appears to be both accurate and extraordinarily progressive. Pal's perspective on the significance of Bitcoin has evolved the most since then. Early on, he was unaware of the extent of currency devaluation, which is the gradual but unabated decline in purchasing power brought on by governments creating money to pay off mounting debt. He believes that dynamic is currently the main macro force influencing the entire world economy. Pal now refers to cryptocurrency as the greatest macro trade in history as a result of this revelation. He thinks that the only assets that may preserve or increase wealth are those that are scarce, like Bitcoin, gold, fine art, and even collectible vehicles, as major fiat currencies are depreciating at a rate of about 8% annually. However, Bitcoin is unique because it is digital, portable, programmable, immune to dilution, and scarce. Pal sees it as perfect collateral for the internet age, a more robust and versatile form of gold that gains value with widespread use. Furthermore, he believes that Bitcoin is just the beginning. Pal contends that the larger crypto ecosystem, which is based on smart contracts and high-performance Layer 1 networks like Ethereum, Solana, and Sui, will be the site of this change's next stage. He claims that these platforms will open up completely new digital economies, propelling cryptocurrency into a complete technical revolution and far beyond the idea of a store of value.
So it's built for the internet. It's a networked asset. You don't know who owns what gold, but you know every single thing that happens with blockchains. You've got an asset where the more you talk about it, the more you onboard people, the more the value goes up. So you have behavioral incentives built in to bootstrap this network. So Meltem Demirtas, an investor in the space, one of the OGs, has said, we memed a $2 trillion asset into existence, and we did. Because we decided it has value, it had value. We built social consensus. That's never happened outside of gold. We built social consensus around some code and said this is a better form of value. And so it's been a very different journey, because once you look at how networks are valued, they're valued by something called Metcalfe's law. And Metcalfe's law is based on the number of users on a network and then the total value transacted on that network. That is why Amazon stock has been so good, and Microsoft and Tesla and Google and Facebook. They're all Metcalfe's law, the adoption of a technology. And Bitcoin is the adoption of technology. It's driven by Metcalfe's law, and Metcalfe's law is much faster than a standard cash flow analysis model. It's more valuable. And because the number goes up, it keeps bringing more people into the network, which secures the network and creates a bigger network and more opportunity sets. We've literally not had anything like this before. If you think of social media as an asset, that's kind of where you've got to within this.
Raoul Pal currently likens Ethereum to the early internet core infrastructure, which was safe, extensively used, and necessary for everything that was built on top of it. According to him, Ethereum serves as the blockchain's Manhattan, the central hub for the most valuable transactions, including DeFi, NFTs, and tokenized assets. Solana, on the other hand, stands for efficiency and speed along the transactional rail that may one day make it possible for on-chain stocks, lightning-fast payments, and large-scale consumer applications. Additionally, Sui's move-based architecture might be the next big step in blockchain performance, ushering in a new era of technology for the whole sector. The upcoming crypto period may produce its own set of strong winners spanning Bitcoin, Ethereum, Solana, and the next wave of high-performance chains. Much like the previous digital revolution produced the magnificent seven titans like Apple, Microsoft, and Nvidia. This is a compelling parallel that Pal uses to frame this time. In the next 2 years, these assets may achieve valuations that are significantly higher than what most investors can now imagine if his elongated cycle thesis is accurate. Therefore, even if this cycle has transpired in a different way than Pal had anticipated, he views the delay as maturing rather than failure. Every significant cryptocurrency surge is still powered by liquidity, and he thinks 2026 will be the year when this engine finally comes to life. Whether or not investors will be ready when it occurs is the only question that remains.